Hey everybody. For those of you who don't know me, my name is Elaney. I'm the development manager here at Turtle Island Restoration Network. So lovely to see all of you. So just a little about my role. I specialize in grant writing, developing strategies for tracking and reaching fundraising goals, major gifts, researching new funding prospects, all that good stuff. Um, so I am the one who handles the money essentially. So if you ever have any questions about donations or grants or sponsorships, or if you just want to chat about sea turtles and how awesome they are, please feel free to reach out to me. We'll provide contact info at the end and email it to everybody so we can all stay in touch. So the purpose of this webinar is because it's tax season, so taxes are all on our minds. And adding philanthropy to the mix can make things confusing. So we want to break it all down and demystify philanthropic giving, and discuss strategies so that you can maximize it and make your giving more tax efficient. And so not only benefits the organization of your choice, but also benefits you all as a taxpayer. So we're going to kind of do an overview briefly of the new tax laws for 2026 and what those changes might mean. And then also explore some planned giving strategies and tools like qualified charitable distributions from IRAs and appreciated stocks. And just kind of discuss how your generous membership, philanthropy that you guys give to Turtle Island, how it can benefit you guys as well as it benefits us. So I'll just real quickly introduce our panelist. So we have James Stanton with us right now from UBS. He has many years of experience in the industry, and he's the one who's the expert to talk about all this, not me. Um, he brings experience working with individuals, families, and nonprofits to help navigate financial decisions that kind of sit in that intersection of investment strategy, retirement planning, estate considerations, and things like that. So I think, Jim, maybe I'll let you kind of take it away and introduce your work and kind of how you're a saving grace for Turtle Island in a lot of ways and how you support us and what that might mean for all these folks.
Okay, great. So, well, first of all, thank you. Thank you for, for Turtle Island Restoration Network for all that you do for the environment and for turtles and species overall. So, thank you very much for all the good work that you do. And thank you for all the attendees that may have donated to Turtle Island Restoration Network and to other charitable organizations. So, thank you very much for that also. Um, yeah, a little bit about myself first, and then we can talk more about the charitable giving and tax giving. We hope Liam joins the call soon, my co-worker. So I'm a senior vice president with UBS and a portfolio manager. I have an MBA, a master's in business, and also have a minor in environmental science. So way back in the day, and still am interested in the environment. I had a couple of solar energy courses back in the late 70s, and all we could do at that time was heat water. So solar energy has really changed a lot over the last 40 some years. Um, so the environment, et cetera, has always been a passion of mine. Um, so I'm also a certified financial planner, and I thought what I'd do is just quickly run through how I help my clients with comprehensive wealth management. I'll just do this quickly, and excuse me, I have a torn rotator cuff. I went through surgery, so I'm trying to use the mouse, and it's a little challenging right now. So, comprehensive wealth management, how I uniquely serve my clients, and serve is an important word. So, I lead my clients, but I serve my clients. Um, as it says, I have an MBA, a CFP, Certified Financial Planner, Chartered Sustainable, Responsible, and Impact Investment Counselor, Senior Vice President, Wealth Management Division of UBS. I'm also a portfolio manager where I can manage funds for clients with discretion as a fiduciary. And I've taken additional courses within UBS to get a title of wealth advisor. And there's really four areas that I help my clients. First, I help them create and grow wealth, make sure the investments are appropriate. Um, Life insurance, if it's important, make sure it's adequate, and liabilities best made available with mortgages and things like that. Help my clients protect and preserve their wealth, look at the overall investment portfolio, look at asset allocation and diversification. I can help with their overall insurance program, life, disability, long-term care, and adequacy and cost effectiveness, and also their overall tax sensitivity plan. We minimize capital gains tax and minimize portfolio income tax. In these areas is more what has to do with today. Help plan for the distribution of wealth during life in the most tax advantageous way. And IRAs, we have a distribution plan. We put a distribution plan in place. And that's where charitable gifting could come in to play for qualified charitable distributions from an IRA. After a certain age, 70 and a half, you won't pay tax on that distribution. But I also talk to my clients about their transition plan. God forbid, in the event of incapacity, stroke, or Alzheimer's, we talk about having a durable power of attorney and a revocable living trust. And I'm not an attorney, but we bring in other professionals to help draft those documents. And then also gifting to children, descendants, and relatives. There's ways to make gifts to family members and friends and other people that we could do it more tax efficiently and control. You may have heard of 529 plans or gifts for education planning. But yeah, charitable gifting, tax efficiency and control. So donor advised funds is a great way to make some charitable gifting. And when Liam joins us, he'll talk more about that. And I help my clients plan for that distribution of wealth at death in the most tax advantageous way. Make sure the assets are titled properly. Is there a transition plan in place? Who's the executor and successor trustee? Make sure all your documents are put together. Then we talk about the distributions to the spouse, descendants, and any significant others, tax efficiency and control, and then distributions to charity in the most tax advantageous way. So you can make a beneficiary of your IRA to a charity if you like. That way it gets out of the taxable estate and it can be given to charity. And there's a couple of other things we could do. So I'm more than just a portfolio manager, comprehensive wealth management, helping my clients create and grow wealth, helping my clients protect and preserve their wealth, help plan for that distribution of wealth during life in the most tax advantageous way, and then help plan for the distribution of wealth at death in the most tax advantageous way to family and to charity and other significant others. So if you ever want to call me and talk about this, we won't waste any time today, but I wanted to give you an overview of myself and how I can help clients. So my clients, I have many environmental groups and also wealthy individuals, and that's pretty much what I do for my clients. As far as the Turtle Island Restoration Network, TIRN, I manage a portfolio for them, and I have a mandate and to have a strict adherence to exclusions on the portfolio. So let me go over the exclusions that we have so that you'll know that when you're making gifts to Turtle Island, any of their reserve money for the future, I'm investing, and I'm investing it very cleanly with a process and a discipline. So let me share another screen.
Jim McCormick works on the philanthropy side of things. He also has a lot of experience. He's the executive director and senior strategist in family advisory and philanthropy services. So he kind of works with families to navigate intersections of wealth, legacy, and values, helping them think beyond financial capital to, the human and relational dimensions of inheritance as well. And so he's had a lot of experience in the industry. So they'll let Jim and Liam also take that away. And I think I have Liam's presentation as well. So whenever you want me to share my screen, I'm happy to do that and go through that as well. But Liam, thank you for being here.
So the exclusions that I have for Turtle Island Restoration Network portfolios, we exclude any companies that are involved in animal testing. We also are not involved in any chemical producers. We don't have any companies that are involved in firearms manufacturing or selling. We don't have any companies that are involved in military or defense. We don't have any companies that are involved with nuclear power. We exclude companies from that profit in any way from tobacco, and we exclude companies in the oil, gas, and coal industry. These are hard exclusions. I have screens on with UBS where it would, if I attempted to buy, say, Walmart, that would be blocked because they sell firearms, and so that would not be included in the portfolio.
Hey, James, can you hear me?
Oh, hi, Liam. Yes, we can
No,
hear you now.
Sorry, I can hear you all, but you obviously couldn't hear me. Sorry, I think I'm in and I'm speaking. So
You're in. Yeah, I
apologies.
see you and I hear you. I'm almost done going through the Turtle Island Restoration Network portfolio, how on the portfolio, and there's exclusions on the portfolio, and I just went through those. And then I also have restrictions on the portfolio, and let me pull. So with MSCI, you may have heard of them before. They're not affiliated with UBS, but I use their tools when I do portfolio management for screening. And so for Turtle Island Restoration Network and for others, I could screen companies, even though they're not part of that exclusion list that you saw. I can screen companies with the help of MSCI tools and UBS that screens out any companies that have severe controversies related to the impact of the environment. So that's been a helpful tool. Also, companies that have controversies related to workforce diversity, that screens out those companies. I can also screen out and am screening out companies, financial institutions that have been engaging in controversial lending practices, predatory lending. Also, I screen out companies that have controversies and violations as it relates to human rights. So you can see it's a very clean portfolio where I'm excluding animal testing, oil, gas, and coal, nuclear, chemical producers, tobacco. So it's a very clean portfolio. And then also with this extra level of screening out companies. And so that's the process and the discipline that I'm employing. Portfolio, excuse me, is considered a moderately conservative. It's only 35% equities. Liam, why don't you take it away?
Delighted to be with you all today to talk to you about the new tax laws and really how can we use our net worth to fund our philanthropy. A couple of requirements on my side first, just to say that this isn't. The compliance people and that employ me will tell me that this isn't. We're not giving tax advice. It's really just an educational webinar. We're going to go through a couple of the laws that have changed, and the goal really is to hopefully bring some clarity to what can be quite a confusing subject, when giving taxes and the rest of it. And really, why is it important? Why do we, why are we talking about this? Well, when we think about our net worth, and if you think about your own situation, I'm sure that you'll realize that for most people, a lot of their assets are actually illiquid. Only 10% of the US's wealth is in cash. The rest of it, 90% of it, is in illiquid assets. So that would be obviously property. It could be possessions. We all have different types of possessions. Obviously, things like stock portfolios, retirement accounts, and things like that. And so, if we are giving and we're using our cash to give, it's actually quite a small bucket in comparison to what is in our illiquid bucket with everything else. And what is great about the US tax system, as you probably gathered, I'm not a native of these lands. I've lived here for 10 years. That what using different charitable vehicles enables you to do is you can unlock some of the assets that you have to fund your philanthropy, not only because it's tax efficient, but also because you can actually give more if you use your assets appropriately. So what I thought we'd just quickly run over would be three different tax laws are constantly evolving, as you know. There's always different levels of what we can do. So we just have a quick look at what the one big beautiful bill did for charity. There's two areas we'll just quickly touch on there. I always joke that not everyone thinks it's a beautiful bill, but it's certainly a big bill. And we'll just look at two areas which affected charity, retirement assets, and that driving philanthropy. We know that over the last 20 years, the stock market has performed particularly well. Many people have invested wisely, with people like James, who's looking after their money, and their retirement accounts have grown. We can use those assets to fund our retirement, but also fund our philanthropy and potentially when we pass as well. And the last ones, increasingly donors want efficiency in their giving. They don't just want to write checks. They want to have impact. They want to have impact with their donors, but they also want to have impact with how they give. So what does that look like? What does that mean? The tax landscape. Well, oh gosh, I've overclicked. The tax landscape. How has that changed? The changing tax laws. We'll review that. I'm going to talk a little bit about planned giving. What is a planned gift? The planned gift is something that we use in our estate. So in your will, you can leave part of your estate, a percentage of your estate, to a charity. So what does that mean? How do we do that? We'll also be looking at donor advised fund and appreciated assets. What is a donor advised fund? How does that work? How can we use an appreciated asset to fund that donor advised fund? And then finally, we'll look at qualified charitable distributions. One of the things that's changed not this year, but a few years ago, is that not everyone's itemizing anymore. You get an increased automatic deduction. So if you're an itemizer, what applies to you this year is what you can deduct. In the past, if you made a charitable gift, whether it's cash, whether it's a stock, last year, you could deduct that directly from your adjusted gross income, the AGI. That is, after everything has been deducted in terms of what you can, your costs, what is left, and your income, which you're being taxed on. In the past, you could deduct those charitable gifts. What they've now said is there's a floor. So you look at your AGI, and the first 0.5% is not deductible. So you have to be giving more than that 0.5% of your AGI. in order to deduct that from your bids. So things that have worked in the past, particularly in a year, maybe when you've had a really high income or had a liquidity event or something. In the past, we'd say do lots of bunching, bunch everything up. That has less of an impact. It's still what bunching means is putting 2 or 3 years worth of giving into 1 year, put it into your donor advice fund, and then give it out over a period of time. It still applies, but you lose a little bit of efficiency in that. So those are the two main changes from the in tax changes. And what are the strategic tools can we use to stretch your giving? Well, everything that used to work still do. The donor advised fund is still a really great vehicle for maximizing your giving, particularly when we're talking about the assets that are tied up in your state. So what we would always skipped ahead here. So looking at a planned gift. What is a planned gift? Basically saying what are the charities, the organizations that where we know them really well. We love what they do, and maybe we think, well, actually, what I'd like to do is leave part of my estate to that organization. So by thinking ahead, speaking to the organization, speaking to the charities you care about, you can make just put it into your will, put it into your trust, whatever vehicles that you are using to pass on your estate. And as I say, that's not really about the size. It doesn't matter how big it is. It's normally a percentage. You leave a percentage of your estate to the organizations you care about. And it's really important to tell them and to document it so that they can keep informed and they know that it's there, as well as obviously putting it into your will. So that's the first one, planned giving. It's a really effective way. It doesn't really impact you net today, but when you pass, the charity you care about can do that. And I'd also encourage you to look at endowments and things where you could be more specific potentially for how you want to use it. You might say, I really like it to go to X, Y, Z. So yes, the other things to think about when we're planning ahead is, we will cover this later, but if you do have a retirement account, you can actually allocate one of your beneficiaries from the IRA could be the charity that you support, and that's and then obviously the other one we could talk about here when we're planning ahead, we're looking at one of the things that concern a lot of clients, a lot of people is, hang on, I want to support these charities, but am I going to run out of money? Do I have enough money to support me in retirement and do the charity? So there are ways of actually generating income while you're living from your charitable gifts, and annuities of one of those, which we will cover. So donating appreciated assets, and instead of, if you have let's just use the simplest version out there. If you have stock and you sell it, it's whatever you paid for that stock, what you paid for it's called the basis point. Whatever growth has happened in that stock is depreciation. So for what you paid for it and how it's grown, that's called depreciation. And when you sell it, you get the basis for what you paid for it, but you'll be taxed on the growth. So you sell it, you pay the tax, and then you can give that cash to the charity. That's great. But if you donate it directly to the charity, so here obviously if we donate it directly to Turtle Island, the great thing about giving stock directly is that you get the full price of today's stock. That value is deductible, and you're not paying the tax on it. You get that as a deduction, and the charity can sell it and get the full price of that stock. So what that means basically is you haven't lost a slice to tax. The charity gets more money, you get your deduction, and that's obviously very, very beneficial to everyone. As you know, and I'd caveat, you still get your charitable deduction because it really does depend. It's not a full write-off. It does depend on your own situation, but you still get that deduction. So what is a donor advised fund? So if you already have one, you may already know this, but basically a donor advised fund is a charity. So it is the ones that we use at UBS is Fidelity, for example, Fidelity Charity. They are a charity. You make your gift to that charity. That charity allocates that gift to a fund within inside that charity. So that's where the money sits. And you then advise that charity. You advise Fidelity, say, I would like to make a gift to Turtle Island, and then they cut the check and it gets sent to Turtle Island. So you're the advisor, the fund is the charity, and that's where it sits. Now, it's a very efficient way of doing it, particularly for things like stock. Maybe you have some land or property which you want to do. And increasingly what we're seeing is as generations are passing on, sometimes they've got really appreciated asset like jewelry or art or collectibles, things that have value, but the next generation may not be that interested in. So another thing people are increasingly seeing is families giving some of their jewelry, getting a valuation for their jewelry, getting valuation for things they care about, a highly appreciated collectible, and then putting that into the donor advised fund. And it pays exactly the same as an appreciated stock, where you can put that in, you get the evaluation, you sell it, and then that funds the donor advised fund. So on this diagram here, it's simply to demonstrate what we're talking about. You, the donor on the left-hand side, contribute your stock, your collectible, whatever it may be, your property, into the donor advised fund. You get the income tax deduction, it's liquidated, and then you have the ability to make those contributions to the things you care about today. And you can also name a beneficiary with your donor advised fund. It could be a family member, or it could be the charity itself. What I pass, everything from this fund will go to these three charities, or it could be to an heir. So why do we do this? It's with the flexibility. It's really convenient. It's really easy to do now, particularly, let's say you've had a good year, your stock market's done well, you've got a lot of appreciated assets, and you think, actually, now's a good year to contribute to this. I don't know what the next few years are going to be. You've had a liquidity event. So you could fund your charity, you'd fund your donor advised fund today when you have that liquidity, and it will fuel your philanthropy for the next 10 years, 5 years, whatever it may be. It's really simple. You're not chasing multiple receipts from multiple organizations. So it's really, a lot of people refer to it as a charitable bank account. The money's in there, you cut the checks, and you're not chasing people saying, I need a tax return, a tax receipt to do that. It's all done in the one. It's really strategic. It helps when in the years, maybe when you have lower income, or maybe you're retiring, you're not going to have the same income you have now. It's a good way of funding that philanthropy for the long term. And one thing for a lot of people in today's world, the anonymity. You can choose whether Turtle Island receives it from Fidelity and it just says you've received a check from Fidelity, or you can have your name on it. So for a lot of clients, that's increasingly important, particularly when there can be some contention around different organizations. So how does the qualified charitable distribution work? If you are 70 and a half and over and you have a traditional IRA, you have to start making qualified distributions from the IRA. And the great thing about this, you can make those distributions to a charity. And you can see the allowance on there is quite high for this, for each person. And again, the great thing about that is it's not taxed. It isn't affected by a tax. It comes straight out of the charity. It does have to be to a qualified 501c3. And so that's a really simple way, particularly for clients who don't need all of the income. They don't need all of the income. They may have other assets, other income, and because obviously you'd be taxed otherwise at whatever rate you're in for receiving money from that. So you don't need it. It's a really simple way of giving. And the other thing to remember about it, you can also nominate the organizations you care about as a beneficiary of that of the IRA, which again is worth remembering. The charitable gift annuity. The slide looks very similar to the DAF, but this time what you're doing is you are making a contribution to the charity. You make a significant contribution to the charity. The charity holds that contribution and gives you a fixed income for the life, or it doesn't have to be to you. It could be for a beneficiary, someone you care about, and it gives you a stream of income, a fixed income for that time period. And when you pass, at the end of the time period, when you pass, the remainder in that annuity stays for the charity and funds the charity you want. So that's the way. If you're unsure about how much money do I need for my retirement? How much money do I need to keep going? You may not know. This is the way of sort of having an income while also giving the charity something beneficial. The charitable remainder trust. Well, the charitable remainder is a bit more sophisticated, but it's a very similar concept, except and more expensive, because you create a trust, you create a legal trust, you fund the trust with some capital, and again, during the lifetime or period of that trust pays you an income, or pays a beneficiary, whoever you nominate, an income. And then again, at the end of that time period, or end of your life, end of the time period, that trust pays out the charities which you've identified that you want to give to. That's called the charitable remainder trust. It's a very similar tool, except it's not one charity that's holding it. It's a trust that holds that annuity effectively and pays out, and it can continue to grow if invested wisely. Okay, we are nearly there. Well, that was a very quick canter through some of the real common ways in which we can. What I talked about at the start there was all of that wealth that is in illiquid assets can be used to fund your philanthropy in ways, give you more money to be more generous and do it efficiently as well. So I hope that was understandable and not too much gobbledygook. I tried to keep it as simple as possible.
No, that was amazing, Liam. Thank you so much. Really appreciate your expertise on that. I know we're coming to the quick end of our 45 minutes together, but I would love to ask you guys a couple quick questions that I found here in the Q&A, if that's okay. One of the questions is just a general, like something looking for advice on. So if there's anything else you guys can provide advice on this particular area. This attendee said, looking for tips on leaving everything to charity, was just told we need to add a charity to our house deed instead of going through probate. Is there anything aside from these avenues that you would recommend for this person, or any of these avenues in particular you would recommend for leaving everything to charity?
So can you just say the start again? What was the situation?
So just the comment reads, looking for, like, in the webinar, she's looking for tips on leaving everything to charity. I assume, when she passes.
The whole thing. Okay.
The whole thing, the whole shebang. Was just told that we need to add a charity to our house deed instead of going through probate. So
interesting. Okay.
that's
Yeah.
what it
So
says. So
okay. So rather than going through probate, you can do that. So I guess it depends on a couple of things. I'd say, do you have the charities? Is there more than one charity that you want to support? And is it something which you just want to happen, or is it something which you have heirs that might want to help distribute those funds as well? So if you have a number of organizations you want to do, it's relatively simple to put it in your will and say it would go through probate. Probate, at the end of probate, it would go through it all, and whatever's left would be split normally by percentages to the charity, to the things you care about. It's hard to do. You can't to my awareness, you can't put your house, obviously you're living in you because you can't put it into a donor advised fund while you're still alive because you need to sell it and it needs to be sold. So, James, what are your thoughts on that? Because I'm a little bit more. It's not my expertise exactly on that area.
Yeah, I have not come across that before as far as adding a charitable organization to the deed of real estate. Definitely talk to an attorney about that one. I wouldn't know where to go. I do,
No.
though, have had clients that had a life estate where they're able to live in the property during their lifetime, and then it reverts to an entity after their life. So that you may want to look at something like that. But this is definitely in an attorney tax advisor realm, way beyond what Lee and I would recommend. Yeah, you need to see legal counsel on that. Sorry.
Oh, gotcha. And then another question, just more of a confirmation, I think would be helpful. Can you confirm whether or not you can name anything besides a qualified charity as a beneficiary in a donor advised fund, or is that the only beneficiary that you could name in a donor
Yeah.
advised fund?
So one of the drawbacks of a donor advised fund is you can only nominate 50 qualified 501c3s. They can't be any other. And frustratingly, even with your IRA, you can't name a donor advised fund because at the moment, donor advised funds and private foundations are excluded. And equally with the donor advised fund, it can only be 501c3s, which you can nominate as beneficiary. You could put an heir as a beneficiary who then just continues to make distributions, but no, it has to be a charity.
Gotcha. And I think Ken has his hand up. Go ahead, Ken. Or did you mean to?
No, I did, and I was trying to ask a question, but I can't because I think I'm on the host side. Um, for the donor advised fund, can you guys please confirm that when you move money into the fund, that's the date that matters for your tax returns? In other words, you've funded the fund, so to speak, and then that you can claim that deduction that year, even if you give the money to charity in subsequent years. Or do I have that the wrong way around?
No, that's correct. So
That's how it works. Yeah.
yeah. So just remember what I said about a donor advised fund. It is a charity. You are making a gift to a charity, so it has to be made by the 31st of December every year. So that's when you'll get your tax receipt for whatever you've stuck into it. But it has to be done by the 31st. But you can then make those distributions whenever you like over the coming year. The other interest I should have said as well is that with the donor advised fund, there's no actual requirement at the moment to make any distributions at all. Now, and I know Alina will be rolling her eyes saying, no, don't say that, but you don't have to make a distribution the whole idea is that you have time to think about how you want to make those distributions and who to. And while because they'll be invested and potentially growing in the donor advised fund while they're in there.
Right. So not to belabor it, but if December 1st rolls around and I sold some stock or got some RSUs or something like that, and I didn't know what I wanted to do with it, put it in the donor advised fund. And then if my research takes me into the next calendar year, even the following calendar year, I've still realized the tax benefit when the event or when I funded the fund, and then my choices and research can come later.
Correct. That's
That's
exactly right.
right. So I've had clients like your situation where they come into a large capital gain event, a liquidity event, fund the DAF at that time of the tax year that they had this large gain event. And that's like what you said, we had, selling stock by the end of the year, do your DAF this year and fund it.
And on that, James, and I didn't mention on here because it's getting to the more complicated side of this, or not overcomplicate things. But
Right.
if you are
Yeah.
a business owner and you have a business, what people do if they know they're going to start thinking about selling it, you can actually put own part of the ownership of that business into the donor advised fund. So providing you're moving towards a sale, you cannot have signed any sort of binding documents, but you could put a percentage, 10% of your business interest into the donor advised fund. It's valued, and it is valued as it goes in. It's a little bit of technical stuff because you have to get lawyers to value it and get a value of it. It goes in, it sits in there, and then when you sell it, it obviously is sold, and then you have slightly more tax efficient way of funding your donor advised fund.
Awesome. Thank you so much for that. And I know we're definitely at time. We've taken enough of your time. So I don't see any more questions. So if there's any questions that anyone has that pop into their head, feel free to email to me. And we'll try to get you guys some answers about the best ways to give. But I want to say thank you so much, James and Liam, for being here today, sharing your guidance and perspective. And it was such a pleasure walking through all of this with everyone here. Thank you for joining us. Thank you for spending your evening / afternoon with us, depending on your time zone.
Where we are.
Yeah, and if you have any questions, I'll send an email after the session with contact information and things like that. So if you
Well,
have any
that's great,
questions about
Alina.
this, yeah, so we can stay connected. But yeah, appreciate everyone for coming, and thank you, James and
Pleasure
Liam.
being
Have a
here.
great
It
night.
was a pleasure working with you, and thank you again for all that you do at Turtle Island Restoration Network. Thank you very much.
Thank you,
And to
everybody.
the donors as well. Thank you, donors.
Thank
Yes,
you, James and Liam. Thanks, everybody.
thanks,
Okay,
everybody. Have a
have a
great
good night.
evening.
Bye-bye.
Bye.